money. So they had not spoken. This is now July 2021. They had not spoken.
Good evening once again to all of us. Welcome to Assurance Professional School Management Accounting Revision class for day 2. In fact, yesterday we met to discuss and appreciate certain concepts that are very key in the ICAG exams for management accounting. So yesterday we looked at questions concerning throughput accounting, environmental management accounting, break-even analysis, and all of that. So today we promised to continue from where we left off, and then we'll try as much as possible to cover majority part of the questions that I have circulated. In fact, if you are not able to finish all of them, try as much as possible to find time and try your hands on each and every one of them, so that you increase your chances of passing the exams. Prepare hard and be ready for the exams. In fact, I wish us all the very best in our preparations. So let us jump straight into our business for the day. Our business for the day is to continue with where we left off. I think yesterday we were able to finish up to question number 3. So question number 3 has to do with throughput accounting, I believe. Let me see. Okay. All right. So yesterday we were able to solve up to question number 3. If you have not been here yesterday, in fact, there's a link for you to watch the video and go through what we have learned yesterday. So yesterday's question 1 was on break-even analysis. We went into it. We explained how you are supposed to go around this particular question. And then also the management accounting aspect, environmental management accounting aspect. We went through it thoroughly. And then also question number 3, which has to do with what? Throughput accounting. So we're able to solve all of these things in detail yesterday. Today, we are continuing from question number 4. And question number 4 has to do with a product life cycle. A product life cycle. All of these form part of the contemporary approaches to management accounting. There are some concepts yesterday I tried to remind ourselves of what we are required to capture under the syllabus. So you are supposed to capture issues concerning models of evaluation, the contemporary approaches to management accounting, the break-even analysis, budgeting, budgetary control, standard costing, investment appraisal, short-term decision-making, divisional performance evaluation, both financial and non-financial evaluation, as well as long-term decision-making, where you are supposed to appraise a project or a particular equipment that the business intends to undertake. All of these things must be well understood before you enter the exams on, I think, Tuesday. Then also, I have also reminded ourselves yesterday that the exams is not only on practicals, and that the theory aspect is equally important. And so when you are learning, make sure that you don't just practice questions asked in practicals. Make sure you read on the theory as well. About 40% of the questions come from the theory aspect. And therefore, we are supposed to cover all of those things in order to increase our chances of passing the exams. Okay. So let's look at question number 4. Question number 4. Now, the question says, companies operating in an advanced manufacturing environment are finding that about 90% of a product's life cycle cost is determined by decisions made early in the cycle. So you're saying companies operating in an advanced manufacturing environment are finding that about 90% of a product's life cycle cost is determined by decisions made early in the cycle. In fact, if you join us, kindly mute. Kindly mute. Okay. So companies are operating, they are saying that about 90% of the cost of the product, its life cycle, is determined by decisions that are made in the early stages. So management accounting systems should therefore be developed that aid the planning and control of product life cycle and monitoring monitor spending at the early stages of the life cycle. So we are trying to, okay, if you have brought on board a particular product, let's say your new idea is to bring on board Colgate paste, the toothpaste. Now, at the early stages, you'll be incurring certain costs. At the latter stages of the product, before you even maybe fade out Colgate paste and bring on board a new product, the early stage of the Colgate paste production is where you spend a lot of money. So you are supposed to incur costs like research and development, marketing, promotion, because at the early stages, people don't even know what Colgate is. So most of your costs in relation to that particular product will be incurred at the early stages of the product. And then at the latter part, because you have incurred most of the cost at the beginning stage, the latter part, you may not incur so much. So the product life cycle costing is more of giving us a fair idea, an overview of all the costs that we will incur over the life cycle and all the revenues we will get from the sale of that particular product. And then we determine as to whether it is profitable or not. That is the whole idea about the product life cycle. So the preamble in the question is saying that, and it is quite true, that at the beginning stage of a product, before you even introduce the product onto the market, it is quite expensive. In fact, if you are introducing a product into the market for the first time, at the beginning stages, you don't expect to be making profit. You can be running at loss from the inception, but when we get to maybe the latter stages of the product life cycle, that is when you begin to make some form of what? Profit, or recover your cost of investment. And if it exceeds your revenue exceeds that cost of investment, then of course you'll be making some form of profit. Okay, so let's look at the first question, which is A. A says that we should explain the nature of the product's life cycle. That's the product life cycle concept and its impact on businesses operating in an advanced manufacturing environment. So we are saying that, okay, so what is the impact of this, or what is the nature of the product life cycle in the first place? You should explain that concept. That's what the question is saying. And then aside that concept, how does it affect the operations of a company that is, or a manufacturing company that is far advanced? That is far advanced. So you are supposed to look at it from two angles. First of all, you explain the product life cycle, what it means, or what are the stages in the life cycle, and then also how that will impact upon a manufacturing company that is ahead of the curve or ahead of its competitors. Okay, that is A. Then the B says that we should explain the life cycle costing. B says we should explain life cycle costing and state what distinguishes it from more traditional management accounting practices. So this time we are trying to juxtapose and compare. We are trying to compare the life cycle costing technique against other accounting practices that have been implemented over this period. That is what B is requiring us to do. Then the C aspect says we should explain briefly the concept of what? Activity-based. Of course, we are done with throughput accounting. We are done with it. So you can watch the video. If you have not been here yesterday, you can watch the video and see the concluding part of it. So the C part of the question says we should explain briefly the concept of activity-based management. So it's no longer about life cycle costing. Now we are shifting our focus onto what we call activity-based management. And then we should give two benefits that its adoption could bring for a business. So when you adopt what? The activity-based management or costing, how would that benefit a particular business? How would it increase or perhaps benefit you in one way or the other by virtue of what? Implementing the activity-based costing or the activity-based management. So this is a typical question. Theory-wise, you are expected to write a lot and explain the concepts accordingly and try to convince the examiner that you truly understand what you are writing or what these concepts mean. Okay. So let's go ahead and look at let me share my screen. Okay. Okay, so the A part of the question is talking about the nature of the product life cycle. And then the nature of the life cycle, the product life cycle costing, and also its impact, or how would that affect companies that are far in advance or manufacturing companies that are far advanced in operations. Now, when we are looking at the life cycle of a particular product, it happens to be in 4 stages. We have the introduction stage, product life cycle. Or the stages. Oh, the stages in the product life cycle. So the first stage is the inception or the introduction stage. Introduction. There are certain things that happen under the introduction stage. We'll look at them briefly. Then also, after the introduction stage, we move on to the growth. The growth stage. And then also the maturity stage. And then the last bit talks about the decline stage. The decline stage. So when they ask you for a product life cycle, this is how it is, or these are the stages that a product goes through. So I was citing an example about Colgate. If it, the typical example, let me just cite, is the phones we have been buying, particularly let's say iPhone. So before you, who is this? Hey. Why nobody can hear me? Everybody can hear me, right?
Yes, please, we can hear you.
So why is somebody saying I can't hear anything?
You should connect to the audio.
Okay. So the product life cycle is in 4 stages. So we have the introduction stage, the growth stage, the maturity stage, and then the decline stage. A typical example I was trying to cite is in the tech industry, especially iPhone. Before you realize iPhone has released a new one, it doesn't take long, then they have a new one. It does, you see, they have a very short product life cycle. So a product life cycle is talking about when you introduce that at the stage, the time at which you introduce a particular product, how or the time it takes for it to grow into the market for people to get to know it. Then it gets to a particular stage where you call the saturation, the maturity stage, where virtually everybody is aware of the product, competition is tough, and that maybe the profit level will try to reduce. And at that time, the product is beginning to decline. So the saturation stage is the highest level where almost everybody or competition for that particular product or your competitors have also risen to match whatever you are doing. Then you are the same page. Because of that competition, if you don't take time, you may lose your customers and hence your product will be moving downward, which is the decline stage. So this is how it is, the product life cycle is in terms of a diagram. So we have sales volume here, and then also the time it takes. So usually the introduction stage, this is 0. Nobody knows the product. Okay, nobody knows the product. So let me just say it starts from here, introduction, then it climbs, it gets to the peak, and then what? It declines. So let me just say this is the introduction stage, the growth stage, the maturity stage, and then the decline. So we have introduction. This is the introduction stage, the growth stage, and then the maturity stage. And then the last one is what? The decline stage. So you realize that for sales to be increasing, or when you introduce a particular product into the market, at the initial stage, it will be 0. The sales will be 0. And you are going to incur a lot of cost for people to know about this particular product. How would you get to, when I introduce a particular product, a new one onto the market, how would people get to know? So at that stage, I'll be incurring a lot of, even before I bring the product onto the market, I'll incur costs such as, so introduction stage. Introduction stage. I'll be incurring costs such as okay. So at the introduction stage, before you even introduce the product onto the market, you incur costs such as research and development. You'll be incurring costs such as setup costs. You'll be incurring costs like marketing and promotion. So for you to get people to know about your product, if you don't do extensive marketing and promotion things, people will not get to know your product. So when I bring on board a new toothpaste onto the market, the ones that are already on the market are basically Colgate, and then what's the name? I think the most common ones are Pepsodent and Co. And now I'm coming to introduce my own Assurance toothpaste. Now, when I'm going to introduce that, how will people get to know it? Even before I bring the toothpaste onto the market, If I don't do a lot of research and development, I cannot bring on board, I cannot bring that assurance toothpaste at all. I need some kind of equipment and all of those things. I have to set up properly. And then before people will get to know that there's a toothpaste called assurance toothpaste, I have to do extensive marketing and promotion stuff. So if you look at the thing, you realize that at the introduction stage of the product life cycle, you are going to incur a lot of cost, yet sales will not be so high because people don't know the product. People don't know what? The product. So at the introduction stage, you incur a lot of cost, yet your sales level is low. But when you keep doing this, when you keep what? Okay. When you keep on marketing and engaging in this kind of promotion stuff, people will get to know about assurance toothpaste. And when people get to know about assurance toothpaste, then they'll begin to what? Recognize that, oh, there's an alternative to the ones that we currently have on the market. Now, when people get to realize and they are okay with it, then they begin to patronize it. Then at that point, we have moved from the introduction stage into the growth stage. Now we are going to penetrate. The growth stage is about penetration, getting more customers, influencing those people who are currently buying Pepsodent and Colgate to switch to buying what? Assurance toothpaste. So you are going to penetrate into the market. The more you penetrate, the more market share you have. And at the growth stage, to also incur what? Some form of what? Marketing and promotion. You continue doing it. Okay. So you still continue doing your marketing and promotion stuff at the growth stage in order to get more customers on board. So you realize that so far the introduction stage, you are going to incur a lot of cost. But when you go to, let me say, the growth stage, our cost will still incur, but it will not be so much as compared to the introduction stage. Then when we get to the maturity stage, this time around, competition has been the market is saturated. Almost everybody is producing toothpaste. And hence, competition for your customers will also be high. Maybe somebody has introduced a new product. And those people, that new product they have introduced, they are trying to get your customers. Also, your customers are moving away from you. Now, at the maturity stage, you don't do so much. That is a stage at which you will be able to make some kind of what? Profit. But the moment your profit level is decreasing because of higher competition, because the market is what? Saturated, or a lot of competition is in there, then your product begins to die down. Patronage for your product will come down. People would begin to look for alternatives. And when it gets to that stage, then you know that your product, the product you are selling, has gotten to the decline stage. And when you are getting to the decline stage, then your profit level will be decreasing. And when it decreases to an unacceptable level, then you are going to do what? Withdraw from the market, or you shut down production. But even before you shut down production of that particular product, you are supposed to consider a lot of other factors. So product life cycle costing. This is the product life cycle. That is what I've just demonstrated on the board. But the costing is whereby at each stage, how much are we getting as revenue? Then also at each stage, how much are we incurring as what? As cost. Over the life cycle, or over the period, the product will be active. These are the two things. So the product life cycle is in two forms. Or the cost, what we are looking at is in terms of revenue over the long term. The revenue is not just about the revenue at the introduction stage. It includes introduction, growth, maturity, and what? Decline. All the revenue put together before the product fizzles out of the market. Then also the cost involved. How much are we incurring at each stage? Or bump together. So at the end of the life cycle of the product, the revenue minus the cost should give us either a profit or a loss. So if you are able to do proper life cycle costing, you know that this particular product you are undertaking is worthwhile or not by looking at what? The long-term picture of that particular product. So the life cycle costing is basically talking about the revenue you get from a particular product and all the costs you incur over the lifetime of that particular product. The lifetime is from introduction, growth, maturity, and decline. And most of the time, it is at the introduction stage that the cost involved is very high and the revenue is low. So if you want to just base it on the introduction aspect, at the introduction stage, you may be making losses. Now, the time you may begin to make some profit is when you get to maybe the growth stage, because your cost may not be so high or your cost involved may not be so high, but now revenue will be increasing because you are getting a lot of customers on board. And then at the maturity stage, yes, you have a lot of customers at that level, but right now competition is also tough. Because of competition, price competition, and all of those things will factor in. Your competitors may be offering what? Lower prices. And you must also be forced to maybe reduce your price or find an alternative way of what? Competing. Well, now when it gets to that level, then you realize that no, I cannot wrestle with my competitors anymore. And the competitors are taking over your customers. What do? Now the product begins to what? Decline. So these are the four stages which we are supposed to keep in our mind. Which we are supposed to keep in our head. And then we should also know that at this stage, there's some form of cost and there's some form of what? Revenue that is generated. And if you are looking at life cycle costing, you're looking at the over the life cycle, over the period, over the lifetime of that particular product before it fizzles out. Now, the other aspect of the question is talking about how that will impact onward an advanced manufacturing company. Now, when it comes to an advanced manufacturing company, now, when we are referring to an advanced manufacturing company, you realize that there's some form of economies of scale. They enjoy some kind of form of what? Economies of scale. By virtue of saying that they enjoy economies of scale, for them, they can produce in very large quantities. And because they can produce in very large quantities, their cost of production is low. And hence, because of this, the life cycle of what? The product will be elongated. The reason why it will be elongated is because they can compete favorably. They can compete well because their cost of production is low. Because they are producing in very large quantities. By virtue of them, what's the name? Producing in very large quantities, then the product life cycle continues to exist for a very long time. If you are competing with such companies, then you may be what? You may leave the market because you cannot meet their standard, because they are very big and then their machines are quite sophisticated and they can produce in very large quantities. Now, even before they get to that stage, it is also very important that we know that at the introduction stage, they were able to make huge investments. What has made them an advanced company or an advanced manufacturing company is because they have made considerable investment. And so the investment at the beginning stage definitely will be high. Their assets they buy, the kind of employees they get on board, highly skilled employees, all research and development, their department is very sophisticated. They use IT to help them bring on board very good systems to get correct product on the market. When that happens, you realize that at the introduction phase of their product, will be very costly. But going forward, that also translates into what? A longer life cycle or a life cycle of the product, because they can compete favorably and their product can be a leader on the market for a very long time. So that is the impact that what the life cycle costing will have on what a company that is what an advanced company. An advanced company. So first of all, we are supposed to draw the life cycle, the product life cycle. From the introduction, you mentioned the stages, some of the costs that you incur at each of the stages. And then you know that if you say life cycle costing, you are referring to looking at the product life cycle, like the period in which the product will be in existence from introduction to its decline stage, all the costs that you incur minus all the revenue. So all the revenue incur minus what? Okay, so somebody is asking if the impact is only economies of scale. No, you cannot, it's not only economies of scale. If you look at what's the name? The global market. The global market, for example, the global market is very competitive. In terms of, let's say, if you look at the car, I was citing iPhone and Go as an example. So the global competitive market. So you can have the global competitive market as another point, an impact. So if you look at the global competitive market, you are referring to how competitive globally the market is. So if you look at, because of the competitive nature of the market, the life cycle of the product become very short.
I mean, tells you.
They
I don't
become
know
very
what. Say, product life cycle.
Okay. So because of the global competitive market, you realize that competition is very tough, is very keen, and companies tend, or those advanced companies tend to bring on board new what's the name, product in very quick succession. So I was citing iPhone as an example. Because of competition level, iPhone doesn't take long to release what? A new product. And that makes what? The life cycle of its product very short. You see, so one of them is that economies of scale. You can give them the opportunity to what? To produce very large quantities. And at what? Because they are producing large quantities, their cost of production will be low. And because of that, they can equally compete favorably with what? Their competitors. The other one too is that the market is very competitive. You realize that people are competing against each other. And hence, one product, you cannot keep one product on the market for too long. Especially in the car and then the, what's the name? The phone one industry. You realize that, oh, this Benz has released a new brand, this one has, it doesn't take long. The product life cycle, they move on from one to another. So very advanced or advanced manufacturing companies, these are some of the things that life cycle costing have the impact it has on them. So one of them, you can talk about economics. The other one too is about the nature of what? The market in terms of its global competitiveness. If you wait for too long, in terms of competitive market, you realize that your competitors will release like 3 or 4 products and you'll still be lacking behind. And by virtue of that, the life cycle of this product tend to be what? Very short. Okay. I think we can move on. So that is the first aspect of the question, which is the life cycle. Then the other one happens to be the B part. The B part says that we should, let me check. What is the B saying? The B says we should explain life cycle costing. I think I've spoken a lot about life cycle costing. And then we said we should state what distinguishes this from what more traditional accounting practices. So by now, I think we know what life cycle costing is because of the explanations that I have given. But let us try and find the distinguishing factors. What distinguishes this life cycle costing from the more traditional management accounting practices? What distinguishes it? Okay, so B, distinguishing factors. So if you look at one of them is that when you look at our normal accounting practices, mostly we do periodic reporting. Most accounting reporting systems are periodic in nature. So if you look at it, you realize that our account, the statement of financial position, the statement of comprehensive income, it is based on what? Yearly basis. So we look at periodic. We don't look at the big picture of the thing. But life cycle costing looks at the bigger picture. It doesn't break it down or looks at it only at maybe on a periodic basis, maybe 1 month, 2 months, or 3 months, or 4 months. But our traditional accounting system, what we do is that basically at the end of the year, we do all our debits and credits and prepare an income statement to show the profit for that particular year. Not thinking about what will happen in the future. But if you look at life cycle costing, it goes beyond what is happening now and goes far into even the time that the product will die off. So one of them is that the most accounting systems are based upon what? Periodic accounts. Rather than focusing on the revenues, rather than focusing on the revenues as well as what? The cost accumulated. The cost accumulated over the life cycle. Accumulated over the life cycle to date. So yes, as we all know that our accounting, basically the accounting we do is periodic, 6 months, 1 year account. We don't look at it from what? From inception to the decline state. So we don't look at it from the what? That perspective. We prepare the account on periodic or upon periodic what? Period. So that is one of the difference between, or the distinguishing factors or factor between life cycle costing and our traditional accounting system. The other one is that we generate recognition of the commitment needed over the life cycle or the entire life cycle of the product will generally lead to more effective resource allocation than the traditional annual budgeting system. So when you are looking at the product life cycle, you know that, okay, this product is going to take 6 years. I have calculated how much it will cost me to sell the product over these 6 years. And then also how much I'll generate as revenue from this particular project or product. Over this period, I'll have a fair idea, and that will influence the way and manner in which I allocate my resources. If you know that this particular product will not give you so much profit at the end of this life cycle, then you may want to use your resources to undertake a different product. You see? So that is one thing. That's one of the distinguished factors. Let me just put it on the board. Talking about resource allocation, life cycle costing, leads to more effective resource allocation. More effective resource allocation. Resource allocation. And then also, so these are the two distinguishing factors. Two distinguishing factors. So we have question 4A and Z. And then question 4B also and Z. So if you look at the last aspect, it's talking about activity-based costing. And the activity-based costing is talking about identifying the various activities that take place in the organization. And what are those drivers? What are those things that take place that will drive or increase the cost that you incur on each of these activities? So that is what the C aspect is talking about. So the C is talking about what? Activity-based costing. And then what are those benefits? What are benefits from activity-based costing? So you can look at the benefits of activity-based costing, which is the C aspect. So we should understand that. C, benefit. First of all, you should understand ABM, or some people say ABC. ABC is what? Activity-based costing. Okay. So what are the benefits? One of the benefits you can get is better understanding of cost and their causes, better understanding of cost and their causes. If you are able to do ABC properly, you are better understanding, you better understand cost. You can also use the information at the planning stage. Information at the planning stage. So you can look at it from the planning, use the information at the planning stage, can lead to what? So you can use it to, you can use the information at the planning stage to properly allocate resources. And then maybe the last one, which is maybe 3. You can also look at opportunities to reduce or eliminate non-value adding products. Highlight opportunities. You can highlight opportunities by using the ABC. Helps you to highlight the opportunities to reduce or eliminate what? It can help you to highlight non-value adding what? Activities. Eliminate non-value adding activities. So these are some of the benefits you derive when you are using activity-based costing. In fact, there are more than 3. You can go ahead and go and read more about it. What we mean by activity-based costing, what we mean by life cycle costing. What are those benefits that you derive when you are using life cycle costing? What is the difference between the life cycle costing and more traditional accounting practices? And then also activity-based. In fact, activity-based costing even have some practical aspects. You can revise that as well. So I think that is all for question number 4. These are the things that question number 4 is asking us to do. So you are supposed to first of all explain the life cycle and then also draw this life cycle. Look at the cost involved at each of the stages and then look at how does that impact upon advanced manufacturing companies, the distinguishing factors, and then also the benefit of activity-based management. All right. So let's move on. In fact, we have question number. This is, yeah, hello? Or you're not talking? So question number 4 talks about incremental budgeting and zero-based budgeting. Please go and solve this one on your own. The preamble is saying that some commentators argue that with continuing pressure to control costs and maintain efficiency, the time has come for all public sector organizations to embrace zero-based budgeting. So if you look at the question, you realize that the argument is between incremental budgeting. The argument is about incremental budgeting and zero-based budgeting. If you look at question number 5, question number 5. So kindly go and read question number 5, solve it for yourself because it is quite self-explanatory. The difference between zero-based budgeting and activity-based budgeting. This is a question that can come under budgeting. So we have budgeting and budgetary control. So read this aspect. What are the advantages of zero-based budgeting? And then also the disadvantages of what? Zero-based budgeting. And then incremental budget. When we say incremental budget, what does it mean? When we say zero-based budgeting, what does it mean? Okay. That said, which we should all go and do for ourselves. Let's move on and look at the next question, which happens to be question number 6. So this is question number 6. Question number 6 says that we should Praise Company Limited is a medium-sized company. Praise Company Limited is a medium-sized company, produces a single product in its one overseas factory. For control purposes, a standard costing system was recently introduced. So you realize that this question is about standard costing and variance analysis. So question number 6 is saying, Praise Company Limited is a medium-sized company and it produces a single product in its one overseas factory. Now they have given us the standard cost for the month of May. They gave us production and sales, which is 16,000 units. And then they also gave us the materials we use to produce that particular product. So the product materials are 007 XL90. And then the labor we also incur. And then the overhead cost. The overhead, they are telling us that all of it is what? Fixed cost. Then the first part is talking about what? The standard. Then the next part is referring to what? The actual. So you'll be given 2 things, the standard and what? The actual. So by virtue of having the standard and the actual, you can perform variance analysis. So you look at it, then let's look at the actual data. They say produced 15,400 units. 15,400 units for the month of May or the production, which were sold at how much? 138 dollars 0.25 pounds. That's $138.25. Then the materials was also given to us, which is 98,560 kilos. And that was for an amount of $1,256,640. And then the material, you don't forget that the materials they give us are 2. And then they also give us information concerning the labor. They give us information concerning what? Labor. Then they went ahead and they also gave us information about fixed cost, that is actual fixed cost. They gave us fixed cost too, the budgeted or the standard fixed cost, and then the actual fixed cost. In fact, this question is very interesting, and they may even ask a question that is in this nature. You may see a question in the exam that's in this kind of what? It takes this kind of form. So let us pay attention and see how best we will go about this. Let us pay attention and see. So the A part says we should prepare a standard costing profit statement. And then a profit statement based on actual figures for the month of May. So the A is saying we should prepare two things. The profit statement should have both standard and actual. We should have profit statement that is both standard and what? Actual. Then the B says we should prepare a statement of the variances which reconcile. So we are going to prepare a reconciliation statement. This is very interesting. So we're preparing a reconciliation statement using the variances with the standard profit or loss figure. We shouldn't compute for mix and yield variances. Then the C says we should explain briefly the possible reasons for interrelationship between material variances and labor variances. Then the D part says you should state two possible causes of an adverse labor rate variance. So this is the question. Let us shift our focus to trying to understand and appreciate these things into detail. I think we shall go ahead now. Let's move on. Okay. So question 2. Sorry, that's question number 6, I believe. Question 6. So question 6 is asking us to prepare the standard and then the actual profit and loss statement. But before we go ahead and prepare this, we need some what? Basic data to be computed. So we are supposed to determine the variable cost per unit, the standard variable cost per unit, because they said we should prepare the standard profit and loss statement. So what we do is that first of all, they have not given us the standard variable cost per unit. They didn't give us the variable cost per unit, but they gave us the material and they also gave us the labor. They gave us labor and they gave us material. So if we want to determine the variable cost per each unit, then we are supposed to compute it because we need it to prepare that statement. So this is part of our working. So let's determine the standard variable cost per unit. Per unit. They gave us the materials. Materials they gave us, we are looking for material 007, and then they also give us XL90. Don't forget, we are looking for variable cost. So the items that are in the question that forms part of variable cost are the things we can bring here. Then the next one is what? Labor. Okay, so the variable material, they said we can have 6 kilos. 6 kilos at $12.25. That was it per kilo. That's what they gave us. Then also they gave us for the XL, they said we can use for 1 unit, we can use 3 kilos. And each kilo costs us $3.2. And then they also gave us the number of hours we can use to produce. They said 4.5 hours at each hour. We are supposed to pay labor $8 for $8.4. So in all, if we want to get the variable cost per unit, we are supposed to get these things done. So first of all, we are supposed to multiply. Let's multiply and see how much we will get. The first one, 6 times what? 12.25 gives us 73.5. Then the second one, 3 times 3.2 gives us 9.6. Then the next one, 4.5 multiplied by what? 8.4 gives us 37.8. So you add all of this, then we determine the variable, that's according to standard. The variable cost we will incur per each unit based on the standard. So 37.8 plus 9.6 plus 73.5. That gives us $120.9. So each unit we produce based on our standard, the standard we have set for ourselves, we spend $120.90 on it. The figures are in dollars actually. So this is a variable cost per unit. Then also, how many units can we use? Or in terms of the materials we are going to use based on standard. The question told us that we were able to produce, or our actual production was 15,400 units. That was what the question said. Actual. Actual production is 15,400 units. So this is what we were able to produce actual. So if you produce 15,400 units, then you ask yourself, how much units per the materials and the labor in terms of kilos and hours am I going to spend on this number of units? So we are going to use and say, okay, let's determine the standard word usages. So the standard usage, we have the materials which are 2, 007, and then also I think XL90, and then also labor. So if we have this, and this is the number of units we were able to produce, which is the 15,400 units, then based on our standard, how many units of kilos of material 007? Hey. Okay. If we are able to produce, this is the actual production, which is 15,400 units. Then based on our standard, how many kilos of material 007 do we need? Because based on standard, the number of kilos we can of material 007 we can use is 6. So each unit we produce, we spend 6 kilos. Now material XL90, we spend 3 kilos. So 1 unit of the product we are producing, we spend 6 kilos of 007. Then we also spend 3 kilos of XL90. So if we want to get the total number of materials we will use, then you're supposed to multiply it by what? 15,400 units multiplied by 15,400 units. So you multiply 6 by the 15,400, the number of kilos you are going to get. So you need, how many kilos do you need for 007? You need, this time, this will give us
92,400.
Okay, so this one, you need 92,400 kilos for material 007. Then the second one, how many units or kilos do you need?
$46,200.
46,200. That's fine. So it means that this is the number of kilos we need for us to produce 15,400 units. That is for material 007 and XL90. Then when it comes to labor, we said that labor hours we spend is 4.5 hours per unit. So labor spends 4 hours, 30 minutes on each unit. So if you want to know the total number of hours that it will take for us to produce 15,400 units, then we are supposed to multiply it. And that will give us how many hours?
69,300.
69,300. So this is in hours. So it means that labor is going to take 69,003 hours based on the standard, based on our standard. This is the number of hours labor should use to produce 15,400 units. Fine. Now we can now go ahead and prepare based on this, we can now go ahead and prepare both our actual and what? Standard statement based on the 15,400 units. Based on the 15,400, because we produced 15,400 and we sold 15,400. So first of all, let me just do actual here, and then I'll move to the next page and do standard. So this is our actual statement, or let me say the statement. This is for actual. So we are going to have two columns. The next page, when we move to the next page, I'll prepare, or we'll do the standard there. Now, based on actual figures, our sales, the revenue you are going to make is going to be, they gave us some figure in the what? In the question as the selling price, actual selling price, which is I think 138.25. Kindly confirm. So
Yes, confirm.
138.25. So that is the actual selling price. And then the number of units that we sold was 15,400. So when you multiply the two, then we are supposed to get our revenue. Yes, Arafat.
Sir,
Yes.
please, have you done with the standard? The standard profit statements. Have we done with it?
No. I'm saying that when we are, you see, I've divided the board into two. So
Okay.
when we move to the next page, then I'll do the standard.
Thank you, sir.
Okay. So this is actual statement we are preparing. So when I move to the next page, we'll do the standard. So 138.25 times 15,400. How much would that give us?
2129,050.
2129,050. Okay, so that's the $2.1 million. That is the sales we are going to make. Sales. Then we are supposed to move to cost. You know, we are just following our normal listing. So the materials are 2. We have 007 and then XL. And then we also come to labor. Then the last aspect will be the fixed overhead or the fixed cost. They give us fixed cost as actual fixed cost. But first of all, let's get this right. If you look at the cost aspect, the question also gave us the actual cost for material 007 and material SL. If you look at it, they told us that this was the number of kilos we used for material 007 at this price. Please visit the question again and get what I'm trying to say. So the first one, material 007, it cost us in actual terms 1,256,640. I hope you have gotten that. Then also material XL gives us, if you look at the additional information, the latter part of the question, this is where I'm getting these figures from. I didn't do any computation. It is actually in the question. So material 007 cost in actual terms, it costs $1,256,640. Then Excel also in the question has been given to us actual terms, 132,979. I hope we are all on the same page. Okay. Then we also move to labor. We move to labor. You can add these two for me and give me the figure. Then the labor cost has also been given in the question. The labor cost has also been given to us in the question as actual. Don't forget the statement you are preparing is the actual statement. Okay, so the fixed
Total
cost
material cost
is how much?
is 138,9619.
9619. Okay, so that's 1,389,000. Okay, and then the labor cost has also been given to us directly in the question, which is 612,766. And then the fixed cost has also been given to us in the question, actual fixed cost 96,840. So we can now add all of these three. We can add all of these things and get our total cost. My people, please unmute. Okay, so the total cost. How much will be our total cost when we add all of these things? Total cost should be in the region of 2 million.
That's 2099,225.
2099,225.
Is that it?
22.
2099. Oh,
Yes,
okay, the
225.
225.
225.
Okay. So 2099,225. 2099,225. Okay. So that's our total cost. And hence, based on actual, our profit is going to be, I think we'll get a profit because when we take this from this, it should be positive.
29825.
29852. Yes.
29825.
825.
So that's 29. So that is our profit, our actual profit. That is our actual profit. Okay. Now let's go and prepare the standard statement, the statement for standard. The statement, which is based on the standard, what we did earlier. What we did earlier is for actual. So sales, we're able to sell 15,400 units. And then the selling price was, I think, standard was 140. How much was it? 140? The profit, which profit? Okay. You mean this one, 29,825. I think that's what you are referring to. Okay. Then we have sales. This is standard, based on standard. Because it is based on standard, our selling price will have to be based on standard. The number of units we sold is 15,400. When we multiply, we are going to get
2,156,000. 2,156,000.
Okay, so that is based on standard. This is how much you are supposed to make out of the sales you have made, because the only difference here is because of the selling price, because the standard selling price is different from the actual selling price. Okay, Now let's move on to the cost aspect. The cost aspect, we have materials, which is 007, and then also XL, and then labor, and then also fixed cost. The materials, if you look at it carefully, you realize that the number of units, we're able to determine the material cost per unit. We're able to determine the material cost per unit.
That was 73.5.
Yes. Are we ignoring the standard production and sales figure? Which standard production? The standard production is 15,000. Oh, okay, the beginning. We don't use the standard production again because it is now based on the actual sales or actual production. Now we know the actual, so we forget about the standard production. We don't use that. That is budget. In fact, when you get to the variant, we'll be preparing another statement and we'll use that. But right now, we don't need that as we speak. Prince, I'm answering your question. Right now, we don't need what you are asking us right now. When we move to the B part of the question, we will need it. So just stay tuned and pay attention.
So,
Okay, so
you are not supposed to use the 16,000 for now.
no. Right now, we don't need the 16,000.
Okay.
We'll be calculating a variant. We'll be doing some, you see, the B part of the question, I don't want to jump the gun. Let us move on. You understand very soon.
Okay.
Okay, so we have, okay. So the cost, somebody said, how much is it? 73 something. 73.5. You multiply it by the number of units, which is 15,400. Then also XL per unit. The XL per unit is $9.6 multiplied by 15,400. Then the labor cost. We were able to get, how much was the labor cost? I think it was $37.8 multiplied by the number of units. And then the fixed cost based on standard, they have given us that already. I think they gave us directly, they gave us 86. If you look at the question, they gave us the fixed cost of 86,400. 86,400. So now let us determine our total cost. Let's multiply 73.5 by 15,400. How much we get?
1131900.
91. Is it 11 or what? 11.
Yes, 1131.
Okay. 9.
900.
Okay. Then the next one is what?
147840.
840.
840. Then labor will give us how much?
Five eight
582.
5 what?
5821.
120.
120. Okay,
120.
so let's get the total cost quickly. Total cost. And
1,379,552.
one what?
337,952.
133. Are you sure? Our total cost will be 133. Are you sure? We are adding all of this. The 4 figures. 1, 2, 3, 4. We want the total cost. I'm sure even when you add this to this, it will be more than 133.
It's 1948.
Okay, 1948.
260.
260. Okay, so that will be our total cost. And because our total cost is less than our sales, we get a profit. And how much would that profit be? Let's subtract this from the top.
2077.
207740.
40.
So this is based on our standard, this is the profit we are supposed to make. But if you look at our previous statement, the statement we prepared earlier, you realize that our profit in actual sense is $29,825. But based on standard, we are supposed to make like 207,440, which is not actually correct. So the B part of the question is requiring us to prepare a reconciliation statement. Now, when you prepare a reconciliation statement, what it means is that you are supposed to adjust this standard profit in order to arrive at the actual profit. And before you be able to adjust this particular profit, you are supposed to compute or calculate some variances, which are very, very important. So we are supposed to prepare that. We are moving to the B part of the question, which says we should prepare reconciliation. So you'll be preparing a reconciliation statement. But before we prepare the reconciliation statement, we need to compute for certain variances. Okay. So first of all, let's get one of them, which is a sales price variance. You realize that from the beginning, they gave us the standard selling price, and we also had an actual selling price. There's a difference between the standard selling price and the actual selling price. That will give us a variance. So we are supposed to determine the sales price variance. So the question is 15,400 units should sell for how much? How much should we have sold this? We should have sold it for 2,000.
138.
138.25.
How much would you have sold the 15,400?
Are you talking about the actual sale or
The standard price is
no.
138.5.
No, it's not actual. Look at what I've written on the board. We should have sold it for how much? So how much should we have sold it? So we are talking we should have sold
Okay,
it for
140
yes, so that is per unit.
per unit, yes.
Yes, so that is 140 per unit. But when we are talking about the whole 15,400, then it should give us 2,156,000. That is how much we should have sold it for. But how much did we actually sell it? We sold it for how
that
much?
was 2129.
213,900.
2129.
050.
2132.
Okay. So this is that is where the variance is coming from. Okay. Okay, so we should have sold it for 2,156,000 based on the standard. That is how much we should have earned in terms of sales. But we sold it less than the amount. Did we get the full money from it? We didn't get how much we budgeted for, or the standard. We got less than the amount. And hence we'll be getting a figure that is less than how much we are supposed to sell it for. So the sales price variance is going to be, when you subtract, it's going to be
26950.
950. And you add an A to it to indicate that it is what? Adverse. Because when we sell based on standard, we would have gotten more money. But because we sold at a lower price, we got less than necessary. The difference is the 26,950, which is indicating what? An adverse position. Yes, Arafat.
So, sir,
yes.
please. So if we had used the standard selling price per unit and the actual selling price per unit, we will get the same answer for this price.
Yes, you will still get the same answer. So you find a difference. For example, the actual was how much? I think 140. No, the standard was 140 and the actual was 138.25, right?
Yes, sir.
So you find a difference. Find a difference between these two. What will be the difference?
$1.75, say.
1.75. Okay. So you multiply
please.
this 1.75 by 15,400. How much will you get?
So the same amount.
Very good.
That is 26950. Yes.
Very good. So either you go in this direction or you go, but I prefer to present my answer in this way. That's all. You still get
Okay,
the same
sir.
answer.
Okay, sir.
Okay. So we can move on. Okay. Okay, so the next variance we are supposed to compute is the material variances. So we are supposed to compute for the material variances. Material 007. Let's first of all compute for material 007. Then after this one, we'll go and compute for
Recording in progress.
we'll go and compute for XL. Okay, so if you look at
Sir,
yes,
please, are we not looking for sales volume variance?
no, the sales
The
volume,
sales,
you say?
are we not calculating for sales volume variance?
Okay, so when we get to the latter part, we'll look at that. So first of all, let us keep to the sales price variance. So the sales volume variance, we look at labor variances, the overhead expenditure variances. If you compute for the sales volume variance right now, we will not get our actual price, our actual profit. So first of all, we are supposed to stick with the sales price variance. That is where our concentration is on right now.
Very well.
Okay. So let's look at the material. The materials are in two forms, so let's keep in mind. We are supposed to compute for two of these materials. How many materials are we supposed to use? Under normal circumstances, 15,400 units. How many units should we have used? Should have used how much? So if we are using material, this is standard, though. This is standard. So based on standard, 15,400 units should use how many kilos? Don't forget that they said 1 unit of the product we are producing, material 007 requires how many? 6 kilos. So if we are looking at material 007, then we have already even computed it. You can just go back and refer. We have computed it. So you should have used how many?
29400.
29. Are you sure it's 29?
Sorry, 92,400 kilos.
So 92400. Sorry.
Very good, very good. So 92,
Sorry.
that is how much we should have used to produce it. But how much did we even use? Did you use how many? How many units did you use? You go to the latter part of the question, you realize that they gave us the actual. How many did you use? We use 98. Look at
98560.
yes, so that was the number of kilos we used. So we are supposed to subtract this one from this and get an answer and multiply that answer by our standard price. So let's subtract and see how much are we getting?
6160.
6160. Is it adverse or favorable?
Adverse.
Okay. Now, the reason why it is adverse is because based on standard, we should have used 92,400. But in actual fact, we went to overspend our standard. We spent more than what we budgeted or what is our benchmark. Let me put it that way. So we spent 6,160 more. And this is in kilos, 6,160 in kilos. So if you want to convert this thing into amount, then you multiply it by the standard price. How much was it? I think the standard price was 12.25.
12.25.
Okay.
That,
So when
that
you
will give you
multiply
75460.
7 what?
75460.
460.
460.
So that is the usage variance in terms of usage in dollars. This one is in dollars. That is 75,460. But this one is 6,160. This is also adverse. That's adverse. So there's 6,160 is adverse though, but it is in kilos. It is in kilos. Then let's move on. Let's move on and look at.
Hello, sir.
Yes.
Hello, sir. Please, before we move on, please, I want you to go back and then I want to ask a few questions.
We will not finish.
Respect of. Just a quick question. Okay, so I'm just comparing the sales variance and then the material variance. You said the first one is adverse, the second one is adverse.
Yes.
I think that the first, if I'm correct me if I'm right, I think the first one is favorable rather. Well, that was positive, and then this one is negative.
Oh,
when you subtract this one, you are getting negative.
Okay.
So the first one is favorable.
Let me clear your mind. In fact, a lot of people make that mistake, and when I was also growing up, I made similar mistakes. Now, the difference between the first one and the second one is that the first one is revenue.
Okay.
Then the second one is cost.
Okay.
So the sales price variance, when you sell less and you are getting what's the name? Positive, what it means is that you're not getting a lot of revenue.
Okay.
Do you understand?
Yes.
I am supposed to sell the thing for 140 based on my standard. I'm supposed to sell one for $140. And I went to sell it $138. Am I not losing?
Yes, you are losing. Yes.
That is why it is an adverse.
Okay. Okay. Thank you very much.
Do you get it?
Thank you very much.
But when you come to the material aspect, that one is cost. So I think, yes, you are not the only one. A lot of people get confused with that. But I think you should be fine now.
Yes, I'm okay.
Okay.
Thank you very much.
You're welcome. So I think we'll move on to which other one? I think XL, material XL. $15,400 should use and then did use. Should use how many?
46,200 kilo.
46,200.
46,000.
How much did we actually use? It is in a question. Did use XL. How much did you use in actual terms?
42,350.
42,350. Okay, so this one gives us a favorable condition because based on standard, we are supposed to get more material. The material I'm supposed to get is 46,200, but we went to buy, or the one we use is less than the standard. And because it is cost, this one gives us what? A favorable condition. But what's the difference?
3850.
3850. And then you can multiply this thing by the standard cost. Standard cost. And the standard cost, I think, was, is it $3 or
3.2?
3.2, okay. So you multiply it by this and you get in terms of what?
12,320.
Okay, so 12,320.
320.
And that is what? Favorable. This is the usage variance. Then we can also compute for the price variance, material price variance. This is usage variance. This is material usage variance. What we are doing now is talking about the variance, the difference between the materials we used. But we are now moving to the difference in the price. We budgeted that we will buy it at 20 cedis. Maybe we bought it at 25 cedis, or maybe we bought it at 15 cedis. Now, that is the price variance. But if we budget that we'll use 20,000 units of or kilos of a particular, and we want to use 25,000, that one talks about the variance in the material we have used. But the price is how much we bought it. Is it favorable that we bought it at a lower price, or it is an adverse that we bought it at a higher price? So this, what we have just done, is talking about the materials we use to produce the thing. Then we can now move on to the price, material price variance. Material price variance. We are going to do it for 007 and 007, 15,000. Okay, how many materials did we use? How many kilos did we use actually?
92,400 kilos.
007.
Yes, please.
If you look at we are talking about it did cost. We are looking at the actuals now. Did cost us.
The actuals, okay. Okay, yeah, this is standard.
So how many kilos did we get? How many kilos did we use? How many kilos did we use to produce the thing? So we use 98,560 what? Kilos. If you look at the actual portion, now this is the number of kilos we use for material X, material 007. This is the number of what? Kilos we use. But when we bought this number of kilos, how much are we supposed to buy it? We are looking at price variance, so we are supposed to buy it at 12.25. But how much did it cost us? It cost us, I think they gave us the figure. It did cost us 1,256,640. Please pay attention. We are looking at the material price variance. So now we want to get the difference between how much we should have bought it and how much we actually bought it. So the number of units or the number of kilos we used to produce the 15,400 units is 98,560 kilos for material 007. But when we bought this 98,000 kilos, based on standard, the price at which we are supposed to buy it is $12.25. $12.25. And that should give us an amount of, let's say,
1,207,000.
Yes.
360, yeah.
But in actual fact, we paid how much? We paid 1.256 thousand, which is telling us that based on our standard, we should have bought it at a lesser price. We are supposed to buy it based on our standard. We are supposed to buy it at a lesser price, which is 1.2 million, 1.207. But we actually paid more. And hence, whatever answer we are going to get here is going to be adverse. Our target here,
49,280.
Okay, so 49,280
280 advert.
adverts. All of these figures are in dollars. All of these things are in dollars. All of these things are in dollars. Okay. So this is for material 007. Then material XL. How many kilos did we use for XL?
42,350.
So we use 42,000, 43,000. Am I correct?
Yes, 42,350.
42,350 kilos. And how much based on standard are we supposed to buy one?
3.20.
3.2.
Okay, 3.20. But how much did it cost us?
132,979.
132,100
979.
979. Is that it?
Yes.
Okay, and then the first one, the top one gives us how much? 135,520.
135,520.
So based on standard, we should have paid 3.20 for it, which is higher. If you look at it, it's like, oh, based on our standard, we should have really paid more, but we want to pay less. And this one gives us a favorable condition. Because
2,541.
2,541. So that
Favorable.
is our material price variant for XL. This is favorable, but the material, what's the name? The material price variance for material 007 is in adverse position, which is 49,280 adverse. But for XL, it is in favorable condition. So far we have computed the sales price variance. We have computed the material variance, that's the material usage variance, and then also the material price variance. After this, we are supposed to go ahead and compute for the labor rate and labor efficiency variances. So this particular question actually is asking us virtually all the variances in the question, in the syllabus. Because when you are preparing a statement, a reconciliation statement, you are supposed to compute all of these things based on what the data has given you or the question has given you. You are supposed to break it down into all of these things, compute them, and be able to prepare the reconciliation. Okay. Very soon you see how the reconciliation is done, but let us finish with this one. Okay, then the next one is for us to prepare or compute the labor efficiency variance. Labor efficiency variance. Labor efficiency variance. Now, the reason why we did a lot of work for material is because of the material being 2. So we are supposed to do for all the 2. But if you look at material labor efficiency, the labor is only 1. It is not, they have not divided into, what's the name? Skilled and unskilled or something. This one is just one labor. So we'll just be doing one computation. We'll not be doing many computations. Okay, so our efficiency is talking about the number of hours we have used. Labor efficiency. So efficiency is talking about hours, but the labor rate is talking about the cost of labor. But first of all, we now want to get the hours. So the standard labor efficiency. So ideally, how many hours are we supposed to use? 15,000 units. 15,400 units. Based on standard. This is the number of units we produced and sold. Based on the standard hours we've set for ourselves. How many hours are we supposed to use?
$69,500 and 300.
How much? 69,300. So based on our standard, this is the number of hours labor is supposed to spend to produce the 15,400 units. But if you look at the additional information, how many hours did labor use? It is in the additional
Sir,
information.
please, I have a question.
Okay. Who is asking?
Okay, I'm okay.
Are you sure? Okay, let's continue.
Yes.
Okay.
Yes.
So the 15,400 units should take how many hours based on standard? The standard hours is 4.5 hours to produce one. So you multiply the 4.5 hours by the 15,400 units and you get the number of hours you are supposed to use based on the standard. But in actual fact, how many hours did you use? That has been given to us in the additional information. I think labor used how many hours? 70 hours, 70,840. So you realize that labor used more hours than it budgeted or than what? The standard. You are supposed, based on standard, you're supposed to use 69,300 hours. But we went ahead to spend 70,840. I hope we have all seen where the 70,840 is in the question. Okay. Because we spent more hours than the standard, this becomes an adverse position. And that is going to give us how many hours?
1540.
1,000. Then if you want to convert this thing into figure, then you are supposed to multiply it by the standard rate. You want to convert it to a monetary value, then you multiply it by what? The standard rate. How much is the standard rate? Labor was being paid how much? I think $8.4 or something.
40%.
8.4.
8.40.
So you multiply it by 8.4 and you get, okay, let me
12,936.
let me put it here, 8.4. So you get how much?
12,936. 12,936.
When you multiply it, are you sure you get 12,936?
Yes, please. 12,936.
Okay, 936. So that is adverse. But this is what? In figure. This is what? In value. Efficiency in value. This is an amount. Let me put the dollar sign here. But the one here is in hours, 1,540 hours. It is in adverse. This is also adverse, but the only thing is that we converted from hours to what? To value. Then we can move ahead and compute for, that's the first one we did is efficiency. Then we can compute for labor rate. Labor rate variance. So now you are trying to find a difference in how much we paid, not the number of hours. What we did first was in terms of the number of hours. By this time, we are talking about, okay, how much did we actually pay? So we used 70,840 hours in production. Should have cost us how much? It should have cost us how much? Because if you look at it should have cost us 70,840 times 8.4. And that it should have cost us 59,000 or $559,056. I hope we understand how I got this.
Yes.
Oh, there's 70,840 is in the question. Let me share the question. Question number
6.
Question number 6, okay. Okay, so if you look at it, you realize that they say labor paid an actual rate of 8.64 per hour to the labor force. The total amount paid out was 612,766. So if you want to get the number of hours, you only divide it. That's what I'm saying. It's in the question. So 612,766 divided by the rate per hour, which is 8.65. If you do it, you get 70,840 hours. I hope you have gotten it. Okay. I think we can move on now. So that is the number of hours we used. Should cost us, how much should it cost us? It should cost us the rate based on standard. And the standard rate is 8.4. 8.4. So you multiply the 8.4 by 70,840 hours. And this is how much you should have actually paid for labor. But how much did you pay? Did it cost us how much? We paid
612,776.
612,766. So that is how much we paid. So you realize that we paid more than our budgeted based on our standard. We should have paid 595. What is the difference? So this one gives us an adverse what? Position.
7,710. 17,710.
Okay. So an adverse what?
Adverse.
Position. Because we paid more than our standard. So this is the labor rate variant. This is the labor rate variant. This is the labor rate variant. Okay. Let's move on. So now we are done with material.
Sir,
Yes.
please kindly explain how you got the 70,840.
I just
I
did.
did a question, sir.
I just did. Okay, so if you go to the question, if you enter the question, the latter part of the question, they told us that the actual labor rate per hour was
8.65.
8 point what?
65.
And they said the total amount we paid,
It's 612,766.
612,766. This is the rate. This is the hour, per hour. So it's
Yes,
like
please.
we are getting 8.65 multiplied by the number of hours should give us an amount of how much? 612,766. This is the rate. Each hour you have paid 8.65. So the number of hours you do, you multiply it and you get a total amount. And they gave us the total amount, but they didn't give us the hours. So it will become 8 point. This is mathematics. Hours is equal to 612,766. You divide it by 8.65 divided by 8.65. And then the hours now become how much? 70,840.
Okay.
I think it is clear
Thank you.
now.
Yes, please.
Okay. Okay, let me. Okay. So we are done with labor variant, and we are also done with material. The material is divided into two. We are also done with the sales price variant. So it's left with the last aspect, which is the expenditure, the fixed overhead expenditure variant. The fixed overhead expenditure variant. The fixed overhead expenditure. Those are the things that are in the question. So we are supposed to make sure that we use the data available to us and compute these variances accordingly before we can prepare the reconciliation statement. Okay. So let's look at the fixed overhead expenditure variant. They gave us fixed overhead, budgeted and actual. Variance. The fixed overhead expenditure variance. They gave us budgeted fixed overhead. They give us budgeted. How much did they give us budgeted?
86,400.
46,400.
46,400.
86,000. 86,400.
86,000.
The math.
Yes. So that is, oh, the data, the question we are solving is actually for the month of May.
Oh, okay.
It's for the month of May. So this is actually correct. So budgeted fixed overhead, based on budget, this is how much you are supposed to incur each month. Then the actual fixed overhead,
96,840.
96,840.
840.
So you realize that even with the overhead, we spent more than we budgeted. Because we spent more than we budgeted, it becomes what? An adverse variance. So what's the difference? Let's subtract this one from this. Or any of them.
10,000.
How much?
10,444. 440 adverse.
Okay. So all of these things are in dollars actually. So we have 86,400, 96,840. So the fixed overhead variance or the fixed overhead expenditure variance. Look at the budgeted. How much do we budget for? Or based on our standard, how much do we budget for the fixed overhead? It was 86,400. But in actual fact, we spent more than we budgeted. And hence we are in what? An adverse position. We are in an adverse what? Position. Okay. So based on this, we can now go ahead and prepare our
Recording in progress.
So the reconciliation statement is actually trying to help us ascertain our actual profit. All of these things, all these variances we computed are going to assist us to prepare the reconciliation statement. So this is how the reconciliation statement is done. Reconciliation statement. Reconciliation statement. So all the variances are going to be here. And then some of the variances are favorable. Let me just say F. Some of them are favorable. Some of them are adverse. And then some of them are also what? So there are two. We have adverse and what? Favorable. The variances are either adverse or favorable. Let me just put the dollar signs here. So all the variances we computed are going to appear here. The ones that fall under favorable will come here. The ones that fall under adverse will go under A. But before all these variances will come in, we are supposed to start with our budgeted profit or our standard profit. Our standard profit. So we start with our standard profit. Standard. When we prepare the standard statement, we got a standard profit of 207,740. So this is what we are going to adjust with the computations we have done. Our standard profit. So we start with our standard. The reconciliation, what I think we understand what reconciliation is. If you say you are reconciling, what you are trying to do is that you want to bring the two of them into agreement. Now the first thing we did. Let me just bring us our minds back, cast our mind back. Okay. So we prepared a statement here, I'm sure. So this is the actual statement. When we prepared the statement, this was the profit you got in actual sense, which was 29,826. Then we came to prepare the standard. We got 207,740. Now, this is based on standard. But our target is to reconcile. If you are reconciling, it means you want to bring this standard profit into agreement with what? The actual profit. And that is why we are preparing the reconciliation statement. And by virtue of preparing the reconciliation statement, we are supposed to go through all these variances, compute them, and use them to prepare the reconciliation statement. Otherwise, you will not be able to prepare the reconciliation statement. Okay. So now let's begin. The first one we completed was the sales price. The answer we got, was it favorable or adverse?
It was
It was what? Then
it was adverse. That is
how much was it? Okay, so the next one was
26,950.
26,950. Then the next one we computed was the material usage. The material usage we did for 007 and then also XL. Then we also computed material price.
Actually,
Go for 007 and what? XL. Then I think the next one we did was labor efficiency.
Yes, please.
And then also labor rates. And the last one we did was a fixed overhead expenditure variance.
So please, a question.
Okay.
So please, why is that we are not using sales volume here?
So that was what I was saying, that the sales volume. So let's go back. I think let's go back to the question. What was the number of units we budgeted? What was the number of units we budgeted? How many units did we budget?
16,000.
16.
I don't finish you. I don't finish you.
Hey,
Did it?
please mute your mics. Okay, so yeah, somebody was asking a question. Let's continue. Yes, you said how much was the volume?
So please, 16,000.
16, and then how much was the actual?
15,400.
15. So what's the volume variant?
600.
Okay, so in that case, in fact, in this particular case, the sales volume, because we are not actually concerned or too much. If you look at all the variances we computed, our target was on the actual unit that was sold or that was produced and sold. If you look at all the variances we computed, even when we were computing the material price variant, the material usage variant, our attention was not on how much we actually budgeted, because how much we budgeted will not actually influence the prices we paid and the selling prices, the profit we have gotten. That is just a budget we have done. We have done that budget. That was the initial thought that, oh, we wanted to produce and sell 16,000. But in actual fact, did we produce and sell 16,000? Even though there's a variance in there, it doesn't really affect our profit level. It doesn't affect our standard profit because look, if you look at the standard profit we are using here, it does not, when we're computing, let me go back. Let me go back. Okay, so when we were actually computing for what's the name? The standard statement. Look at the sales volume we used. We use how much? 15,400. Because we didn't use the 16,000 as our standard, if we include that, what's the name? That volume, the sales volume variance in our reconciliation, then our profit or whatever we'll get as reconciliation will be wrong. Look at the standard we have done here. We based it on the actual production and sales. If you look at our standard statement, look at the sales portion. We use the standard word unit that we've sold, which is the 15,400. Had we used the 16,000 units here, then that is where we will be using the volume variant when we are doing the reconciliation. Do you get it? So right now, because our standard, if we want to get this thing in sync with our reconciliation, then we are supposed to follow that trend by looking at what only the sales price variant in our reconciliation. We didn't use the 16,000 here in our computation of the standard statement. And hence, if we go ahead and use 16,000, we'll be getting our answer wrong. Okay.
Okay, so sir, please does it mean that if you happen to use the 16,000
yes
in the computation of the standard profits, meaning your answer is going to be wrong?
No, your answer will be correct actually, but in that case, you are supposed to involve this the sales volume variant in your reconciliation statement.
Oh, okay.
I hope you get it.
Yes, please.
Okay.
Thank you, sir.
You are welcome. Okay, so we can move on. So we have the material usage. So the material usage variance, how much did we get for the usage variance? Was it adverse or favorable? Material usage. Oh, we don't have the figures. Okay, I think the material usage, the 007, we had an adverse figure of
6160.
Hey. The usage, I don't have 6160 here. The usage variance,
750.
how much?
7546.
Okay, 75460. That's adverse. Then the favorable, I think the usage for XL was favorable, which is 12,320. The material price we had for this one was 49280. Then for XL, it was 2,541. Then labor efficiency was adverse, which is 12,936. And then the labor rate was 17,710. And then the fixed overhead was 10,440. Let's add the two sides. How much will you get for favorable when you add the two? For the favorable column, we'll be getting something like
14,861. 14,861.
Okay. And then for the adverse side, we'll get how much? 192 776. 192,776. That is what you get for the adverse. And then also, when you add the two, that will give us the total variance. The total variances. The total variances is going to give us, let's subtract the adverse from the favorable. How much will you get? We have two figures. So one is favorable and the other one is adverse. 14,861 minus 192,776. If you do that, how much will you get? Oh, okay.
177 915.
That's adverse. So you are supposed to get your actual profit after this. Your actual profit will be this one is adverse, and your profit at the beginning, which is your standard profit, 207,740. So you are supposed to get an amount of how much? How much will be our actual profit? How much will be our actual profit?
$29,825.
How much?
29,825.
So we can actually go back and confirm if our answer is correct or wrong. Don't forget that question A part of the question said we should prepare both actual and standard statements. So when we're preparing the actual, yes, this was the profit we got. We got 29,825. So this 29,825, when we prepare the reconciliation statement, we got the same figure, 29,825. So when you are preparing the reconciliation statement, this is how you go about it. This is how you go about it. So when you get this actual profit, and it's different from the actual, the statement you prepared for the actual listing, and it's different, then perhaps you have not done something right. The two of them must be the same. The two of them must be the same. So when you are asked to prepare a reconciliation statement, you are supposed to go through all this process, compute all of these variances, and use them to prepare the reconciliation statement. To prepare the reconciliation statement. So this is the B part of the question. Then there's another part of the question which says C. The C part of the question, I'll just go through it briefly. The C part of the question is requiring us to show or indicate some form of relationship between the various variances. In fact, they can ask us in the exams, the relationship between or among some of the various variances. In fact, one of them is that you can decide, for example, to go for if you go for, let's assume you go for what? A low quality material. Now, this low quality material will give you, when you are computing your usage variance will give you an adverse usage variance. I'm trying to give us a relationship between these variances. So an example is that as a business, the material that I'm using to produce my things, I can decide that I'll go and buy low quality. Now, when I buy low quality, it's giving me favorable price because it is low quality. My material price variance is going to be what? Favorable. The material price variance is going to be favorable. But when I'm using this low quality product, it is very likely that a lot of wastage or breakages may take place because the material is not proper. Just by virtue of buying a low quality material, the price, because it is low quality, I'm buying it at a cheaper price. And hence when I compute my material price variance, it will be favorable, it will be good for me. But the material usage variance will be adverse in the sense that you are buying low quality, and because of it is low quality, when you are using it, it may spoil. A lot of them may go waste, breakages here and there. And because of that, a lot of them may go waste. And that may give you a material usage variance, which is what? Adverse. Now, this material price, you can say, okay, I bought low quality, and now it is leading to material price variance, which is favorable. And I want to avoid the material usage variance being what? Adverse. Then I'll go and employ skilled labor. Maybe because the skilled labor is, or the employees are not skilled enough. That is why a lot of the materials are going wastage or they are breaking. So maybe I'll say, okay, to avoid that, I'll go and spend so much to employ highly skilled labor so that when they handle the materials will not break that much. If I hire a lot of highly skilled labor, then that is going to give me labor rate variance, which is what? Adverse, because I'm going to spend so much on labor, and that the price at which I'm going to buy labor is going to be high. And that will lead to what? Labor rate variance, which is adverse, because I'm going to pay more than my standard. But this will also lead to a labor efficiency variance, because I'm employing highly skilled labor. Efficiency level is going to be high. Because of the highly skilled labor, people will have specialized skills and they'll be more efficient. They'll be able to bring out the very best with the little that they have been given. So you see, you realize that just because, as a result of just one thing, it is leading to so many variances. That is the relationship we are talking about. By virtue of getting low quality materials, it's possible because you are getting low quality, the price at which you are buying these materials will be low, and hence your material price variance will be favorable. Now, that may lead to a usage variance which is adverse because there will be a lot of breakages and wastages in the system. Now, we are trying to avoid this usage variance, and you go and employ highly skilled labor. If you employ highly skilled labor, then you know that you are going to pay more for labor, and that is going to give you an adverse rate variance. But by virtue of bringing in the highly skilled labor, make sure that efficiency level is also going to increase because their skill set is top notch. Okay, that answers the C part of the question. I think we understand that one. And then the D part of the question, the D part says causes of adverse labor rate variance. So what are some of the causes of an adverse labor rate variance? What are some of them? Let us contribute. Causes.
So the first one, the first cause that I'm going to give is the wage rate changes. And in that sense, there are times the actual wage paid may differ from the standard rate, which could be due to.
Okay, you said what changes in what?
Wage rate changes.
Okay, so the labor rate.
Yes.
Changes
in the rate.
In labor rate per hour. Let me say per hour. Then what other one? Maybe there might be some kind of what? Promotions.
Okay.
Employees may be promoted. If they are promoted, then it means you are going to pay them higher.
Okay.
And then what can also cause that? So maybe unexpected let me say unexpected increase in market rate
Sir,
hello.
please can we say that machine breakdown, which leads to the
Ideal time.
employees working maybe overtime because the machine is broke
Okay.
down.
Okay.
Yeah,
So because of the
cost
overtime,
will-
you pay them higher, right?
Yes.
Okay, yes, that's fine. That's fine. So you should be able to explain this. So let me finish this one and add what you just said. Unexpected increase in market rate of pay for employees. So maybe generally there has been an increase in what they pay for in terms of market, not just about your business or your company alone, but generally market. Maybe usually you see that the government of Ghana sometimes they revise the minimum wage. So maybe as a result of market in terms of the the revision of the minimum wage, price salary has been what adjusted upward, and you are supposed to pay more to your employees, which is not expected from the onset, and that can cause what an adverse labor rate variance. And then also over time, unexpected by employees due to machine. I think I've captured it well. Okay. So these are some of the causes of adverse labor rate variance. There are many others. Kindly just go through your books. I'm sure you will find so many others to just appreciate them further. So this is all the question is asking us. You're supposed to prepare the statement, which is actual and standard. After preparing this statement, you are supposed to go ahead and prepare a reconciliation statement to bring into agreement the standard profit against what the actual profit. Then you are supposed to explain the relationship between the variances. You are supposed to explain the relationship between the variances. Very good. So yes. So when there's what? Labor shortage. If there is labor shortage, then of course there will be what? Some form of demand for what? Labor. There will be increased demand for labor. If there's increased demand for labor, then everybody needs me. I'm scarce in the market, and hence they are supposed to pay more to me. Or labor, the value or the price for labor will increase, which is unexpected, and it can also cause what? Adverse labor rate variance. I think Seydou has said that in the chat box. Thank you. Let's move on and look at our next and final question, looking at our time. In fact, the rest of the questions, please make sure you go through them before the exam day. You can send me a hi if you don't understand any of them. If you need assistance, you can send me hi on any of the questions. Okay, let's look at question. This one is question number what? 6. Let's move to question number Let me check. Question number. Question 7. Let me check the requirements for question 7. Oh, okay. So question 7 is also about variances. We are supposed to calculate the variances for the last month, the material usage variance, the material mix variance, the material yield variance, and then you are supposed to discuss the problems with the current system and all of those things. In fact, this one, you are supposed to try your hands on it. It's also about variance computation. Try your hands, make sure you appreciate how you compute mix and yield variances. Because this one is testing our understanding on how to compute the mix variance and the yield variant. Let's move on to question number 8. Question number 8. Question number 8. Now, question number 8 says that B5 Company Limited is a large supplier of industrial metals. The company is split into 2 divisions. So this time around, I'm moving to divisional measurement, evaluation, divisional performance, all of those things. That's the latter part of the syllabus. So B5 Company Limited is a large supplier of industrial metals. The company is split into, the company is split into 2 divisions, Division A and Division B. Each division operates separately as an investment center. Don't forget that we have types of centers. We have a cost center, a revenue center, a profit center, as well as an investment center. Please don't forget all of these things. And there are some methods of valuing their performances. Okay. With each one having full control over its non-current assets. In addition, both divisions are responsible for their own current assets. So it's not only their non-current assets, they have control over their own current assets, controlling their own level of inventory and cash, and having full responsibility for the credit terms granted to customers and the collection of receivable balances. Similarly, each division has full responsibility for its current liabilities and deals directly with its own suppliers. Each divisional manager is paid a salary of how much? 120,000 Ghana cedis. So you see, each divisional manager is paid 120,000 Ghana cedis. 120,000 Ghana cedis annually per annum, plus an annual performance-related bonus. So that is the per annum, then before the bonus comes in. Now, they are saying that the bonus depends or is based on the return on investment achieved by their division for the year. Each divisional manager is expected to achieve a minimum return on investment for their division of 10% per annum. So you see, before you be able to, you qualify for a bonus, you must at least achieve a divisional percentage of how much? 10%. That's the return on investment. Minimum should be 10%. If a manager meets the 10% target, they are not awarded a bonus. The 10% is the minimum, so it should be above. That's what they are trying to tell us. If a manager only meets the 10% target, they are not awarded a bonus. However, for each whole percentage point above 10%, which the division achieves for the year, a bonus equivalent to 2% of the annual salary is paid, subject to a maximum bonus equivalent to 30% of annual salary. So that is the preamble they have given us. This is about divisional evaluation. And they say they give us the following figures related to the year. Division A, Division B, the sales, the controllable profit, the net profit, as well as what? The non-current assets, inventory, trade payables, and all of that. Now, during the year ending 31st August 2015, Division D invested 6.8 million. So they are telling us that Division B has invested how much? 6.8 million Ghana cedis in new equipment, including technological advanced cutting machine, which is expected to increase productivity by 8% per annum. Division A has made no investment during the year, although its computer system is badly in need of updating. So you see, Division A has not done any kind of investment, even though the computer they are using is not so good. They have not updated it. Division A's manager has said that he has already had to delay payments to suppliers. You see, so he's also delaying payment to suppliers because of limited cash, and the computer system will just have to wait. Although the cash balance at Division A is still better than that of Division B. Then they are asking us to what? For each division for the year ending 31st August 2015, we should calculate the appropriate closing return on investment on each of the payment of management bonuses will be based. So on what basis are we going to determine the management payment or the bonus? Briefly justify the figures used in your calculation. Then the II says that based on your calculations in part 1, which is I, calculate each manager's bonus for the year ending 31st August 2015. Then you discuss whether ROI is providing a fair basis for calculating the manager's bonuses, as well as and the problems arising from its use at B5 company. And then also the B aspect says we should discuss whether, no, the C aspect says discuss the strengths and weaknesses of ROI and return on investment as methods of assessing the performance of divisions. So if you look at that aspect, that last aspect of the syllabus, you realize that basically the things we learned there are about transfer pricing, economic value added, return on investment, residual income computation, how you have value the divisions or performance and all of that. Those were the things we learned under what? Under performance evaluation in the management accounting syllabus. Any question before I continue? We look at this one. This one is going to be our final one. The rest of the questions, we should try our hands on them before the exam day. Before the exam day. Not just these questions, any other question that you come across, please read them, practice more questions, and appreciate the concepts into detail. Any question? Any question? Okay. No question. Let's continue. Okay. Let's just do the computation aspect quickly, and then also I will just brief us on the theory aspects, and then we move. Okay, so the first one is the AI. The AI said we should compute the return on investment for each of the divisions. So we have division A. And what division B? So let's first of all determine the compute for division A. Now return on investment is equal to the controllable profit. In fact, it is actually profit. But because this time around, if you look at the statement they gave us our controllable profit as well as the profit for the division. They actually sent some cost to us, which is traceable profit. So the profit in the account, the net profit, is a traceable profit. If you read your notes carefully and the last part, you realize that there's a difference between controllable profit and traceable profit. Now, the traceable profit includes costs from head office. Those costs from head office are not under the control of the manager of that division. So if you are using your traceable profit to evaluate the manager, that is not a proper or a good indication of the manager's performance, because some of the costs are not under his control. So if you want to show clearly and know exactly how the manager has performed, then you are supposed to evaluate using the costs that are under his purview, the ones that he can influence. That is why in this case, we'll be using the controllable profit. Divided by our what? Investment or cost of capital employed. Multiply by 100. So this is our return on what? On investment what? Formula. So division A, if you look at it, division A has a controllable profit of how much? How much is the division A's controllable profit? Is it in millions? I hope my people are there.
They're in thousands.
They're in thousands. The controllable profit. Okay, so the controllable profit is 2.6 million. They are in million. Yes, so 2,645,000. They are in millions. They are in millions actually. So it is $2,645,000. That is the controllable profit. I've explained why we are using controller. There's net profit in the question too, but that net profit is the traceable profit. There's a portion of expenses that was taken out that was in relation to head office, which is not under the control of the divisional manager. And so when you consider that money, it is not fair to measure or to evaluate a manager who doesn't have control over some costs. So the best way to evaluate the manager is to use what? The controllable profit, because that one is as a result of his own decisions or the divisions what decisions they have taken. Then the capital employed is going to be all our assets. So there are some non-current assets in there. All our non-current assets are current assets minus any form of what? Liabilities. They gave us, for division A, they gave us our non-current asset happen to be 14,980,000 plus. Okay, let me just go by this. Let me write it this way. Okay, so let me say capital employed. Capital employed. We have non-current assets, current assets, and then the payables, so that we understand clearly. So we have $14,980,000 for non-current assets. The current asset. Oh, let me check the question. How much is the?
I think that is for division B.
Division B. Okay, okay. So division A is 9760. Okay. Okay. This should be 9760. So 9,760,000. Then the current asset is 2,480,000. And then the payables is how much? 2,960,000. So the payables is a negative, and hence before we get our capital employed, we are supposed to subtract our payables from what? Our current and non-current assets. So do this computation for me quickly, and let's see. So ROI for division A is going to be 2,645,000 divided by the capital employed. How much are we getting?
I'm getting 15,200,000.
When you add the 9 million to 2 million and subtract this 2 million, you get 15 million.
Okay.
It's
Okay.
9 million.
No,
It's 9,280,000.
280,000. I think this is it. Okay. So 9,280,000. Then you multiply it by 100. Whatever answer you get is the return on investment for division A. Then we go to division B. Please do the computation for me. The controllable profit. The controllable profit for division B is 1,970,000. How much is the percentage for A?
28.50%.
Okay, so can we get the capital employed for B? Employed. So the non-current assets, the current asset, and the payables. The non-current asset for B is 14,980,000. I believe so. Then the current asset is 3,260,000. And then the payables is, I think, 1,400,000. So how much will be the capital employed for division B? 14,980,000 plus 3,260,000 minus 1,400,000. How much are we getting?
3,350,000.
3 million.
Please confirm.
3 million. Are you sure? We have 14 million plus 3.2 million minus 1.4 million. It should be bigger than that. It should be around, is it 15 million or something, or even 16 million?
16,840,000.
Okay.
16.
Okay. So 16, how much?
840,000.
Okay. So this is the capital employed for division B. If this is the capital employed, then the ROI, return on investment, is going to be the controllable profit, which is, I think I explained why I am using, or we are using, the controllable profit. So bear in mind.
Yes.
And then divided by the capital employed, which is 16,840, multiplied by 100. What to be our percentage?
11.70%.
Okay, so 11.70%. So you can see that division A and division B. Division A is doing like Return on investment 28.5. So it means based on what we have computed, division A is doing far, far better than division B. If you look at division B is operating at 11.7%. That is how much they are getting on their investment. And division A is making 28.5%. What about the investment made? If you read the question, you realize that this investment was made in the course of the year. And they have given us the figures at the end of the year. They said during the year ending. And look at the data. They say the following figures relate to the year ended 31st August 2015. So these figures in the table, or this division A and division B figures, are as at the end of August 31st. The note is saying that during the year, division B invested 6.8. The question or the additional information didn't tell us that they didn't add these things. So the understanding is it has already been included in the non-current assets of division B. I think it is clear. Somebody is saying they have bought assets and we didn't include it. It has already been included. So the non-current assets for division B, which is 4980, has already catered for the 6.8 million. Okay. Okay, let's move on. So we are done with the return on investment. We realize that division A, based on this computation we have done, we can clearly see that division A is doing better than division B. But there are certain things we will look at further in our discussion when we move ahead. But for now, based on what we have just done, division A is doing better than division B in terms of return on investment. Then the B part of the question says that we should compute for bonus. Is it B or II? I think it's II. Say we should compute for what? Bonus calculation. Say we should calculate the bonus. Bonus. Now, if you read the question carefully, you realize that if you read the question, the preamble carefully, you realize that they are telling us if you are a business, a division, and you are making a return on investment of 10%, or let me say above 10%, then you qualify for a bonus. But if you get exactly 10%, you will not get any bonus. And if you get more than 10%, you qualify for 2% what? 2% of your annual bonus. So if you are get every percentage, the bonus paid. The bonus paid for each percentage. If you make a percentage above 10%, each of the percent you get, you'll be making a bonus of 2% of your annual income, which is 120,000. And if you multiply the 2%, you are going to get a bonus of 2,400. So when you are able to make return on investment above 10%, so the extra, any other bonus, any other percentage you get above the 10% gives you a bonus of 2,400 Ghana cedis. But they also said that the maximum bonus you can make is 30%. It is in the question. Read the preamble and see. The maximum bonus is 30% of your, what's the name? annual income. So the maximum you can make as a manager, divisional manager, is 30% of your annual income, which is how much? 36,000 Ghana cedis. Somebody's asking or saying something. Okay. So the maximum you can receive is 36,000 in the form of bonus. But now, how much are they going to earn? How much are they going to earn? Division A. Let me move to the next page. The return on investment for Division A is 28.5%. And from 10% to 28%, Division A is making extra 18 percentage points. Above the minimum percentage, above 10%. It is in the preamble. The preamble is saying that if you make any percentage, a whole percentage point above what? The minimum return on investment, it will attract some form of what? Bonus. So they are saying a whole percentage what? Point to. It's not talking about a decimal point. No. They are saying that each whole. So if I have made, let's say, 12.5 return on investment, I will not be paid bonus on the 0.5. I'll only be paid bonus on the 2% because the minimum is 10.
Recording in progress.
The rest 2%. Will be what? Will attract some form of bonus for me. Will attract bonus for me. So this what I am doing here is based on what the question is saying. The question says we should, let me just go back to that portion and read it for us to understand. So you move, let me see. So they are saying that, however, for each whole percentage point above, they didn't say just above, they said, however, for each whole percentage, whole. So the emphasis on what? Whole. So if I get maybe 3.5 above it or 3.7 above it, the point and those things are not what? Are not necessary. It is only the whole that is necessary. So in the case of Division 1, it has made 28.5. Forget about the 5. The whole one is from 11 to 28, and that is 18 percentage points. 18. Okay. 18. So we move ahead. So let's try and compute for the bonus for Division A. So Division A will be making, so each percentage point Division A makes is going to make 18, and each one of them is going to make a bonus of 2,400 times what? 18. Don't forget, each one you make above 10%, the bonus is 2% of your annual salary, which we have already computed. 2% of your annual salary, which is 2,400. And he has, Division A has able to make 18 percentage points above the minimum, which is 10. So each one of them will attract 2,400, and that will give us an amount of
3,200.
3,200.
Okay. Now this is about the 3,200, but the same question is telling us that the maximum amount a divisional manager can earn is 30% of his annual salary, which we computed to be $36,000. Or I think we are dealing with CDs. 36,000 CDs. That is the maximum that a divisional manager can earn as bonus. But if you look at what the performance of the division the division A has been, they are, according to this computation, they are entitled to 43,200 as bonus. But that will not be given to them. Their bonus will be 36,000 Ghana cedis, because it is above it, and nobody can earn above 36,000. So the bonus for Division A.
Recording in progress.
Is equal to 36,000.
Is equal to.
So the bonus for Division A is equal to 36,000. The reason why it is 36,000 is what I am saying, that they said the maximum that you can earn is 36,000. But when we computed for Division A, you realize that they have earned more than that in principle, because the percentage.
So say, how did you get the 36,000?
Oh, I've done the computation already. We have done it here. Have you seen it?
Yes, please. Okay.
So the bonus paid for each percentage point, they told us that each percentage point you make above 10%, you'll be paid 2% of your annual salary. That was what we did here, 2% of 120,000. That's 2,400. And they also said that the maximum bonus a divisional manager can earn is 30% of his annual.
Okay.
It is in the question 30%. So you do 30% of annual, which is 120,000. So nobody can earn more than 36,000. But when we went ahead to compute for his actual bonus based on the threshold or the figures, realize that he's going to earn 43,200, which is way above the maximum. In that case, the rest will not be paid. You can only be paid 36,000. Okay.
Okay.
Okay. So now let's move to Division B. Division B. Division B's return on investment, I think we computed, was 11 point something. 11.7%.
11.70.
Okay, it's the same. So that's the return on investment for who? Division B. And if you look at the threshold, they said above 10%, you are entitled to a bonus of 2% for each of the whole percentage. So if you look at Division B, the only figure or above it is how much? 1%.
1%.
Yes, 1% ahead of what? 10%. So you realize that it is 11% minus 10%. So it's only going to earn a percentage. So his bonus is going to be 2,400 times 1. And that is 2,400 Ghana cedis. So Division B, his bonus, the manager's bonus is going to be 2,400. Bonus for Division B is equal to 2,400. I think it is clear, because you realize that above the minimum, which is 10%, the only whole number above it is 1, because we cannot even round it. The question says it is a whole percentage, and the whole percentage above the minimum is 1 for only Division B. But when you come to Division A, it is 18. And each of the percentage points above it attracts 2,400 Ghana cedis. And you just multiply.
A little correction here.
Okay.
There's small correction. And Division A, it is rather 28% minus 10%, but I think we made it 10% minus 20%.
Oh, okay.
If we can correct that.
Okay. So 28.
Thank you very much.
You're welcome. Okay, so that is 28% minus 10%. Okay. So 28% minus 10% gives us a variance of at the percentage point 0.01 of 18. Okay. Let's move on. So we are done with, I think, II. This is II. We have done I, which is the return on investment, and then II, which is the bonus for the divisional managers. Then I think that B part of the question is saying we should do some discussion. This one I'm going to talk a lot. Let us pay attention clearly, because if I want to write it, will be a lot. Now, that is B. The B question, the B part, what are they even asking us? Let me see the question. B. B says we should discuss the problems. No, this is not it. B says discuss whether ROI is providing a fair basis for calculating the manager's bonuses and the problems arising from its use as B5 Company Limited for the year ended 31st August 2015. Somebody should help us. Is ROI the best one? Any idea? Is ROI the best measure? Oh, we don't know, or we don't want to talk. Which one? Somebody should try. Somebody is typing for me.
So I want to try.
Okay, try.
So I will say that return on investment may not be fair.
In terms of,
may not be a fair. ROI may not be a fair basis for calculating manager's bonus. And the reason would be that it does not account for the differences in the divisional size.
okay,
And capital intensity or the investment opportunities.
okay,
It just focuses on the short-term profitability at the expense of the long term.
okay,
That is what I can
okay,
say.
okay. Thank you. Thank you for that quick one. In fact, ROI is it's some way very, very. If you read the question, especially the Julius. Julius, is your hand up?
Yes, sir.
Okay.
I just wanted to give my take on the ROI being used on assessing the manager's bonuses.
Okay, okay.
Yes.
We are listening.
Okay. I think yes, what I would say is the ROI provides a fair basis on calculating the manager's bonuses because it uses the profit at which the manager has control over. And
Recording in progress.
And if a manager doesn't have control over a profit or the items that they use in their production, you wouldn't be able to hold the manager responsible or let the manager account for things that he's not having control over. If not, it will be on unfair grounds. I think that's just my take. I'll give on using the ROI on assessing the fair basis of calculating the manager's bonuses.
Okay, okay.
Yes,
thank you very much for your take. In fact,
welcome.
I like the way these things are going. In fact, managers tend to be very manipulative. Let me put it that way. Because because I'll be demonstrating it very soon. Because their bonus is attached to their return on investment, managers try to manipulate their return on investment. Okay, so somebody say it can cause short-termism. That is true. So I'm trying to, let me just explain the whole thing for us to understand. So you see now, they are telling us that, look at this question, they are telling us that the bonus of the managers are linked to the return on investment. Look at what Division B did. Division B went ahead to invest an amount of 6.8 million. Now, one thing about return on investment is that when somebody makes new investment, in the short term, that investment is not going to yield so much money in terms of profit or revenue. But because you have invested 6.8 million, it is going to make your cost or capital employed. It is going to increase your capital employed, and that is your denominator. Do you get it? So if you have invested, the moment you invest, you are bloating your denominator, which is your capital employed. And you not in the short term, you not be getting so much in terms of revenue, and that will also compensate it in terms of your controllable profit. So any manager who is investing so much tends to get so little in terms of return on investment. But the more you make investment, the more it's inure to the benefit of the whole group. I hope I'm just building the point, small, who understand all. Okay. Somebody is saying that it is a fair basis. Don't worry, we'll look at it. So I'm just trying. Now, the decision, we are looking at divisions within a group. And we said that we are trying to make sure there's some form of goal congruence, that all of the divisions work to the benefit of the group as a whole, not in their own interest. So now, if all of them are working in the interest of the organization as a whole, then they are supposed to make certain decisions that does not benefit them alone, but also inure to the benefit of the group. Now, and I'm saying that, look at what Division B has done. Division B went ahead to invest 6.8 million. Looking at the formula for return on investment, you realize that when you invest 6.8 million, it is going to increase your capital employed. Your non-current asset level is going to bloat because you have invested. So in the short term, you realize that your denominator is going to be big. If your denominator is bigger than your numerator, that is going to bring down your return on investment percentage. Because whatever investment you do right now is not going to yield much. It is going to take time, maybe 2, 3, 4 years before you'll be able to get a lot of revenue from that investment. But that investment you are doing too, in the long run, it will benefit the group as a whole. So that is one. So Division B has invested, and that's what has affected Division B's return on investment. Then including technological advanced cutting machine, that is what they use the money for. And they expect that it will increase productivity per annum, like what's that, 8% per annum. So gradually they'll be getting some kind of revenue, but in the short term, they'll not be getting so much. Look at what Division A did. Division A has made no investment during the year. Since Division A has not made any investment during the year, their capital employed is going to be the same. And they may be operating at the highest level, so they'll be getting a lot of profit at that stage because they have not invested in any new thing. So Division A has made no investment during it, although its computer system is badly in need of updating. Do you see what they have done? They need a computer to update too. But he knows, or the divisional manager knows, that the moment they buy a new equipment for that department, it is going to reduce their return on investment. It is going to add up to their cost of what? The capital employed, and that will affect the return on investment. So they didn't update the computer. Division A's manager has said that he has already had to delay payment to suppliers.
To increase his profit.
You see, so he didn't pay. Division A manager has said that he has already had to delay payment to suppliers. That's his payables.
Yes.
You see, he has not paid because of limited cash, and the computer system will just have to wait. Although the cash balance at Division A is still better than that of Division B. So you look at what the Division A has done. Division A has not made any attempt to make sure that it clears its debt. It has not made any attempt in order to buy the new equipment that the company needs. So Division A is actually looking for its parochial interest. If they buy the new equipment, in the long run, it will benefit the group. But right now, because Division A's manager is on profit making or the return on investment, he wants to make bonus at the end of the year. He is refusing to update the computer. Even though on face value, you can see that return on investment is a good measure. Oh, this man, Division A is doing better than Division B. But if you go deep into it, you realize that Division A manager is trying to manipulate the system because he wants to get more bonus. He's making decisions in order to earn big fat bonus at the end of the year at the detriment of the group as a whole. Okay. Before we even get to the control, what's the name? What's the name? The assets or the payables and all these things, the equipment they have not bought. Try and compute the controllable profit margin. So the controllable profit divided by the sales. Let's check and see who is doing better than who. So let me just check. The profit margin. For division, let me say Division A. So it will be the controllable profit. How much was the controllable profit for Division A? The controllable profit for Division A was, I think, 2,645,000.
Yes, please.
And then how much was the sales? That's the sales for Division A. Then
the sales was 14,500,000.
Okay, so let's determine the profit margin for Division A. Let's determine it and see how much we'll get.
18.24%.
18 point what?
24%.
24%. Let's check for B and see how is B faring. The controllable profit for B is how much? 1970. I believe that is correct.
Yeah, 19.
And the sales is how much? How much sales did they make? The revenue?
700,000.
8 how much?
700,000.
Okay. So what is
2264?
What's the percent?
22.64%.
So you see, you realize that Division B is actually doing better than Division A. Have you seen that? In terms of the controllable profit, the profit that is within their means, the one that they can influence. Look at the profit margin for A. A is making 18.24, but B is making 22.64%. B is actually doing better than what? A. But because A has refused to work in the interest of the group as a whole, refused to honor its obligations, refused to buy new equipment and all of those things, it is getting a bigger return on investment because the bonus is attached to return on investment. But if you look at another indicator like this one, you realize that no, B is actually doing well. The reason why B is not earning so much in terms of return on investment is because it has invested an amount of money. And at the initial stage, when you make such investment, you will not get so much profit in the short run. But in the long term, you get a lot of returns, and that will cover for it. But because ASI is on what? Making a lot of bonus. If you look at A has even gotten more profit, bonus than the maximum. A's bonus was around 43,000 something, but the maximum bonus available was 36,000. You see, so even though return on investment is a good indicator, you can see from this angle that yes, divisional managers can tend to work in their own interest, like what Division A has done. Instead of them to try and expand the business, make decisions that will support the long-term survival of the business, they may tend to be looking at their own parochial interest because they want to earn bonus. So they will not want to invest. They will not want to take decisions that support the general view or objectives of the group, but rather they want them to be satisfied at the end of the period. I think it is clear to us. Okay. So that is what the B aspect of the question is saying. The B aspect, this is all the B aspect is saying. We should discuss whether it is fair to use return on investment as benchmark for bonus. Based on this, would you say it is fair?
It is not fair.
It is not fair.
Yes.
It is not fair at all.
It is not. But on the face, we may think that it is fair. Because another person, the division B is trying to help the business as a group in making decisions to support. And you, because you want bonus, you'll be manipulating the system. You realize that no, return on investment actually is not. It's not. Provided we are honest. The only time it will be fair is if Division A is also being honest, go ahead and pay the suppliers, go ahead and replace that equipment, and in that case, then we say it is fair. In that case, we say it is fair. But on this ground, we would not say that it is fair. We will not say. Okay. Let's move ahead and look at the last aspect, which is C. I don't know what C is asking us to do.
You look at the strength. Also suggest further to method.
So you say we should discuss the strengths and weaknesses of ROI. I think this one we can go and look for it. Just look at some of the advantages or some of the advantages and disadvantages of return on investment and residual income as methods of assessing the performance of divisions. So this one we can go through. I think the ICAG manual even has some of the advantages and disadvantages of return on investment and residual income. So let us go ahead and look at that. Then the last one, the other aspect of the question says we should explain two further methods of assessment of divisional performance that could be used in addition to ROI or residual income. So there are other methods that we can use to assess divisional performance. So the common ones we usually come across is the return on investment and what? The residual income. Let's look at other methods. So other methods, which is C. But the benefit, the strengths and weaknesses, go and read them on your own. So if you look at it, you can see that we have, at the latter part of the syllabus, you realize that there's something called economic value added. After we were taught residual income, what was the name? Residual income, return on investment. Then we went ahead that if we want to create value, the best way for us to create value is to use the economic value added, whereby we are supposed to determine something we call the NOPAT, the net operating profit after tax. And then we move ahead and use what we call the cost of capital, usually WACC, to multiply our cost of what? The capital employed. Now, whatever amount we get is known as what? The value we have added. So it doesn't actually use accounting profit, The economic value added doesn't really use accounting profit. The idea behind it is to adjust the accounting profit to get economic profit. And when we get economic profit, we can actually know in actual sense how much value has the business create for itself, or has the project create for itself, or has the division create for itself. So we can use EVA, which is economic value added, in place of return on investment. We can also use another one, which is very common to us. Now, this balance scorecard actually has some 4 perspectives. The perspectives about the balance scorecard, we have, okay, so the balance scorecard is in 4 perspectives. 3 of the perspectives are non-financial, and then also 1 is financial. Profitability index. Okay, so Mohammed Habib Sule Al Hassan saying that we should use profitability index to determine. No problem. We can use profitability index. You can try and check and see if the balance scorecard can serve you better, or the economic value added can equally serve you better. In fact, it is highly recommended that if you want to actually determine the value that a business or a project has created for a particular organization, we should use the economic value added. We should use the economic value added. So the balance scorecard is what I'm trying to talk about. The economic value added is, in a way, looking at 4 different perspectives. 3 of the perspectives tend to be non-financial perspectives, and 1 of them tend to be what? So 1, 2, 3, and 4. So the financial perspective is there, and 3 of them happen to be non-financial. So we have the financial perspective. We have the customer perspective. The balance scorecard. In fact, this balance scorecard is even part of the models of evaluation. So please just remind yourselves, refresh your mind as you prepare for the exams. And then we also have internal business process perspective. Perspective. We have the innovation, learning and innovation.
Learning and innovation.
Learning innovation.
And innovation. And then
Financial perspective.
The financial perspective. So the balance scorecard is of the view that it is not all the time that we should just pay our attention on only financial aspects of a business. If truly we want to assess the business going concern, we want to really know or improve the business survival in the long run and make a lot of money, we shouldn't be so glued to making money right now. That is the idea about balance scorecard. The balance scorecard is saying that if truly we want to make good progress in the long run and make a lot of money, we should be very cautious about the now. It's like you sowing a seed and forcing the seed to be giving you fruit at the beginning stage. If you don't take time, you even kill the tree. So the balance scorecard is saying that there are certain things you are supposed to look at so that it will make your future bright, and they are not financial in the now. Financial is talking about profit, revenue, making a lot of money and all of those things, paying dividends and all of that. Those things are financial perspective. Don't be so glued to those ones in the short term. If you want the business to generate a lot of money for you in the future, think about how to satisfy your customers. Think about ways you can improve your business processes. How efficient are you? What are the research and development things you are bringing? What technology? How are you equipping your workers, employees? What kind of training do you give them? What kind of new ideas do you bring on board? These things, they are not financial in nature in the short term, but all of these 3 things put together, when you do them well in the future, will bring you a lot of money, which will satisfy your
progress.
which will satisfy your financial perspective. So these are the two things you can just look at in place of return on investment and residual income. We can use the balance scorecard. We can equally use the economic value added, or some people call it expected value added. We can do all of these things to give us a fair idea about how the business, or to evaluate the performance of the division. We are looking at division, so we are looking at each of the divisions. So we can use economic value added to know how much value it is adding to the group. And we can also look at the balance scorecard to, if you are looking at using the balance scorecard, then we are trying to look at it from the holistic perspective, not just the financial perspective, but other equally important aspects of the business. Any question? Any question? My people are quiet. And
no, sir, it's not a question. Actually wanted to I wanted to say thank you very much for the day, for the night. I think it's well. It's done quite well. But looking at ICA and your experience in terms of the tutorials to students, what would be your focus heading towards the exams? What areas do you think we should pay particular attention to as we are preparing for the exam? Because you have been taught for a while, and then you know the trend, how they ask their questions and how they do their things. So what will be your focus for the exam?
Very cool. Okay. In fact, predicting ICAG is very difficult, I must say. Anything that maybe you predict and comes, it just sheer luck. Is not about maybe your experience or something. My advice is that let us make sure we touch almost everything before we go into the exams. At least have an idea about virtually everything. And when you enter the exam room, don't leave any space for the examiner. When you enter, even if you don't know, just don't waste your time on it. Leave a space, go and come back. But coming back, make sure that you come back when there is time. So when you go into the exam room, the 15 minutes, take the 15 minutes and go through the questions. Select the ones you think you are very capable of answering and answering well. Those ones can fetch you good marks. And then you now hunt. Don't waste your time on one question for too long and cracking your head. Some of the questions, when you read them first time, you may not understand them. Let me be sincere with you. Usually their preambles are very long. If I say preamble, I think you understand. So the first part of even before they ask you the question or they give you the data to solve the question, they give you a lot of preambles. And by the time you even finish reading the preamble, sometimes time is gone. So I'll advise that when you go, make sure you don't waste too much time. Read around budgeting. Read the areas I'll be mentioning is virtually the whole book. The things we have done from yesterday and today, make sure that you do variance analysis, what's the name? Budgeting, this what we did yesterday, break-even analysis. Also, we're not able to solve questions on investment appraisal. Go and pick questions, practice more questions on investment appraisal. Now, there are decision-making techniques. The decision-making techniques are in two forms. We have the short-term decision-making and the long-term decision-making. So the short-term is talking about make or buy, shut down or continue production and all of those things. Please make sure you learn them. Relevant cost. In fact, when you are making short-term decisions, relevant cost is very, very important. So pay attention to that aspect. And then also look at the long-term decision-making, which is about investment appraisal. So you may be given a question whereby you'll be using a net present value to determine whether you accept the project or not, or you'll be asked to use the internal rate of return, or even the question will come and you are supposed to compute the cash flows yourself before you even use the net present value. You see, and then the budgeting, so flexible budget, revised budget, those functional budgets. What I keep saying, even before I met you guys here, is that there will be a lot of theory questions in the exams. That one, no doubt about it. There will be a lot of theory questions. Part of it, one question, part of it like will be practicals. The rest part will be like theory. So when you are learning, make sure that the theory aspect, you don't neglect them. Make sure you practice the questions and practice the theories as well. So the areas, I wouldn't say that. If you look at what's the name, the manual, if you pick the ICAG manual, you realize that they have given weighting to each of them. The contemporary approaches to management is about like, I don't know, maybe 15% of the syllabus or something. The contemporary approaches, if you look at it, you realize that the contemporary approaches is about 15%. And then the other aspect, so for them, all the areas are very important to them. For them, all the areas are very, very important to them. And so we cannot say that we'll just pay attention to just a portion. Contemporary approaches, 15%, budget and budgetary control, 15%, management decision-making techniques, 15%, short-term decision-making, 20%. So those variant analysis, standard costing, decision-making techniques, and all of those things cover 20% of the syllabus. So our advice is that when you are learning, make sure the weighting of the syllabus guides you as to how much time you spend on each of the areas. And then the exam time too, you are supposed to manage your time properly. Don't go into the exam room scared because you have heard stories about it or you have been there before, you have not done it. Maybe a lot of stories you have heard, oh, then you are scared and you go there. No, 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 no. Sometimes we even defeat ourselves before we enter the exam room. Do you want to waste all your night that you have buried and go and just blow it within some 3 hours? No, go there with a sound mind, with courage, vim, that, oh, I can do something. And that thing I'll do will fetch me more than 50 marks. It's like you going, it's the do or die affair. Try as much as possible. And I know God will take us through all of these things.
Amen. 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 In fact, I'm very happy about the question 8 and the way you've dealt with it. When you read the preamble, it's so easy. But taking us to realize that, oh, it's not that difficult, just that preamble and then the wording of the question. So I'm very grateful.
Okay.
Thank you very much.
You are most welcome. You are most welcome. Okay. Any other? So that we bring tomorrow.
Please, I want to find out. I want us to go back a little to the variance.
Okay.
Sometimes you are asked to use a particular approach in the reconciliation, either marginal costing approach or absorption costing approach.
Okay.
So in that case, how are you going to go about it?
So I think we have a basic understanding of what marginal and what's the name? Absorption costing approach is. So when you are using marginal costing, then it means that we are trying to ascertain contribution. So the variances that relate to the variable cost will be grouped separately from the fixed cost. Do you get it? So when you are preparing using the marginal costing approach, the idea is that your selling price. So first of all, you do the profit before maybe the standard profit. After the standard profit, then you do your variances in relation to material and labor, because those one qualify to be what? Variable cost. Then the fixed overhead will stand alone on its own. We don't add them to the material and labor before we subtract. So you subtract only labor and what's the name? Labor and material from your distance to get contribution. Then after the contribution, you can subtract your fixed cost to get your profit. When you go that way, then you say you are using the marginal costing approach. But when you list all of them together and just subtract, then that one is absorption.
All right.
Okay.
Thank you so much.
You are most welcome. So enjoy your night and prepare well. I wish you the very best in your exams. My name is Mustafa Aminu. Take care. Bye-bye.
So, quick one. When are you getting the last video? This video. When are you getting the video?
Oh, God, I'm sure by tomorrow we should have it. Tomorrow.
Sir, please, can I have your number?
Hello, Mr. Mustafa.
Yes.
Please, can you share your screen with us as well? Yes, this what we did.
Which of the screens? What you are seeing now?
Yes, like what we did this night, please.
All of them?
Yes, please, if that's possible.
This one?
But especially the various aspects.
Okay. In fact, this video will be made available to us. So you can just watch the video again. Or let me just begin. You can take a shot. I think we started from here.
Yes, we started from here.
Somebody is asking for my number. I think the
please.
person is listening. 024
024
56
56
120
120
59.
59.
Yeah, so that's my number. My name is Mustafa Aminu.
Okay, thank you so much.
You are most welcome. You are most welcome. So the person taking the shot, can I move on?
Yes, please.
Okay.
Hello, sir.
Yes.
Please, can you repeat your number?
024
024
56
Yes.
120 59.
02459. Okay. Okay, sir.
Okay, so can you
Thank
mention it?
you. Okay, 024 56 12 059.
That's fine. That's fine.
Okay, thank you.
You are welcome. Okay. Take care of yourselves. Good night.
Thank you, sir.
Okay.
Have a good night, too.
Okay. Bye-bye.
Good night. Thank you, sir.
Okay.